I want to continue a little bit of the discussion on using either average assets or end of year assets in the calculation of ratios, and also demonstrate some of the other numbers using real numbers from Procter and Gamble. This is 10 years of financial statement data from the Procter and Gamble balance sheet and income statement. Their fiscal year ends on June 30th, and so these are the statement data as of end of year June 30th. The revenue as of 6/30/2017 would have been from July 1, 2016 through 6/30/2017. Okay. The assets are on that particular day, so I don't know what they would have been June 1st or March 12th or any other day. I just know what they were on that day. Now, presumably, if you did $65 million worth of revenue, then about a twelfth of it was done each month, unless it's certain companies are highly seasonal. Procter and Gamble is not. If we look at some of the asset categories, these are the current assets: total cash, receivables, and inventory. And if you look at what happened with cash, $3.5 million, $5 million, $3 million, close to $3 million, $4 million, $6 million, 10, 11, 13, 15, cash has all of a sudden leaped up. Okay? If you look at the receivables, 6.7, 5.8 billion, 5.3, 6.26, 6.5. They're actually lower now. All right, now the receivables should be related to revenue, and what we can see is that the revenue has declined over these last 3 years. Okay, the inventory has declined as well. How much inventory do you need to hold relative to the level of sales? The accounts payable have actually increased. All right, now accounts payable are the amount that you spent to buy inventory that you haven't actually paid the bill yet. We have a cash conversion cycle as one of the things we use to measure that. And days of inventory would be inventory divided by 1 day's cost of goods sold. Okay, so if I just toss in a couple of rows in here to demonstrate, if it's 65 billion of sales per year, then if we divide by 365, that's how much they have per day. Same with the cost of goods sold. So the relationship between the cost of revenue and the revenue itself has been fairly stable over this period at about 50%. There's some minor variations, but generally speaking, it's about 50% of their operating expenses are cost of goods sold. Okay, so that's been stable as a rock. And when you see the revenue dropping, you see the cost of goods sold dropping as well. All right, so this is 1 day's sales, and this is one day's cost of goods sold. When we look at inventory, what I can look at here is that the inventory, there's $4.6 billion worth of inventory. If I stopped replacing inventory altogether, if I didn't buy another stick of inventory, and I sell about $89 million worth every day, then how long would it take me to completely sell off that $4.6 billion? And the answer is about 52 days. So that's our days of inventory down here. Now, the textbook chapter just shows you a formula for this. It's better if you understand what's going on, but if you're an undergraduate, showing you a formula is usually good enough. Y'all are going to be masters, so that's why we would like you to understand what you're doing. The receivables, days of receivables, 25.8. Okay, so if we didn't sell anything else on credit and we just took that $4.6 billion of receivables we have, don't add another iota to it. If we sell about $178 million a day, how long would it take till our accounts receivable was exhausted? About 25.8. So days of receivables, 25.8. Days of payables. The accounts payable generally reflect the amount that we're spending on inventory. So if we started paying off the inventory, if we paid cash for our inventory going forward, instead of issuing an IOU, and accounts payable is an IOU, how long before we had ended up paying off all of the accounts payable? Well, accounts payable is $9.6 billion. Divide that by 1 day's cost of goods sold, about 108 days. Okay, so that's generally how we come up with these days of inventory, days of receivables, days of payables. The cash conversion cycle is inventory plus receivables. That's how long the money's tied up after you sell it, minus the days of payables. That's when you bought it from your supplier. What we see here, interestingly enough, if you look at inventory, going back to 2008, they started holding less days of inventory, and it's gone down from between 65 and 75 days to a little over 50 days over the last couple of years especially. The receivables have come down a little bit, but not all that much, a couple of days. But look at what happened with the payables. They were paying their bills within 60 days, 56 days, 70 days, 70 days, 68 days, 75, 73, 77, and then it jumps up to 103 days to pay their bills. They actually comment on this in their 10K saying, hey, our suppliers just gave us longer time to pay. And maybe so. I'd have to dig deeper to understand why that is, but their take on it is our suppliers gave us more time to pay. You have a negative cash conversion cycle, and in theory that's good. It means that you actually get paid for selling this stuff before you have to pay the supplier. Some other things that'll pop up in here. You'll be looking at cash. You'll be looking at common size balance sheets. Take everything in the balance sheet divided by assets. I'm just using cash in here. If I took cash as a percent of assets, now you can see the assets have come down from their height, but look at what happened with the cash. Of our total assets out here, we used to keep about 2.5% of the assets in cash. All of a sudden, we're holding all kinds of cash out here. That's not good or bad. It is different. So as you see, the assets are dropping and cash is going up. That would be a sign of something that I would want to look closer at. I don't know why they're doing this, but I know that it's different. And those are the kinds of things you get from ratio analysis. It's just a quick way of spotting changes that need explanation. A big change in your days of payable, that's a big change. A big change in the percent of assets held in cash, that's a big change. I do want to point out the sales over assets and sales over total assets. If we were to graph this, sales over assets versus sales over average assets, there isn't a whole lot of difference. I think that the sales over assets gives you a better idea of ebbs and flows in there, but really it's showing you the same thing that the sales over average assets is showing. The big difference is that if I wanted to, I have 10 years worth of data for the one as opposed to only 9 years of data if I'm using the average assets. So if for nothing else, that's something that more data is usually better than less data. All right, so that's a quick look at Procter and Gamble. That's the kind of stuff we want y'all to be able to pick out as we go through ratio analysis. The ratios mean nothing. They point you where to look at what's going on with the company.